If you read one article or ask someone on the street, you're likely to hear, yeah, this housing bubble is about to burst, man. Then read another article and you'll hear that this is simply the new normal in house values. So how are you supposed to know what's really going on when everyone's so staunchly married to their own opinions? Well, if you watch my last casual conversation video, I broke down many inaccuracies that these doom and gloom guys are using as evidence of an impending housing bust. On the other hand, the housing market is never static. It does fluctuate. So stay tuned so I can give you real numbers with real insight so you can make a more educated decision moving forward. Okay, first up, let's discuss housing absorption by price range, since this has become everyone's favorite metric now. Housing absorption allows us to see the full current picture. The higher the absorption level as measured by percent, the more competitive that price segment is and illustrates just how difficult it is out there for buyers. First up are homes priced under $250,000. When I started this back in June of last year, there was 1,300 of these homes on the market. Cut to today, and now there's only 220, with an absorption rate of 69%. Now, while this is by far the most competitive price segment, it peaked at about 78% back in April of this last year. Next, we look to $250,000 to $500,000. This remained consistent at 61%. This also peaked in April at 77%. So you can see that competition here has cooled off a bit. Next, let's check out $500,000 to $750,000. This dropped slightly from 43% to 42%, off from a high of 65% back in April as well. Okay, next we have $750,000 to $1 million. This was stagnant as well at 42%, off from its high of 58% in April. Okay, now let's hit luxury, $1 million to $1.5 million. This dropped marginally to 30% from its high of 54% in May. Finally, we have the ultra luxury market of over $1.5 million. This was the only price segment to make a resurgence. It managed to dramatically rise up from 22% up to 28% where it was in June. I wouldn't necessarily read too much into this right now. Let's give this another couple of months and see what our wealthy folks are up to before we make any rash, quick conclusions here. Okay, next, let's peek in on last month's sales. Last month, we sold 3,063 homes. This was actually a 17% increase over last year when we sold 2,628 homes. So more evidence that the market is still very robust overall. Now let's take a look at our current inventory levels. Now, while our sales tell us what happened in the past and housing absorption tells us where the current market pressure is, inventory levels tell us what direction the market is trending towards. So without further ado, let's see what's up. As you can see, we ended last month with just under 3,500 homes on the market. This was a 3% increase over the previous month's inventory. The truth here is that our inventory has been increasing for 4 straight months. Now, let's take a quick moment to unpack all this. Since we sold just over 3,000 homes last month, and we now have about 3,500 homes on the market, that leaves us with only about a 5-week supply of inventory. So while it's true that our inventory is rising, we're still in desperate need for inventory. Remember, a so-called balanced market is 6 months supply. I would disagree and say more like 3 or 4 months. But regardless, we've got nothing to sell. This is how facts can be both true and false at the exact same time. True, our inventory has doubled in only 4 months. Now, if you read that line, you'd think that we're in for absolute disaster. True, we only have a 5-week supply of housing inventory. Now, if you read that clickbait, you'd think that the market is on absolute fire. So which one is it? I think our next metric will sum this up best. Okay, let's now check out what influence all these factors had on the median home price last month. As you can see on the screen now, we ended August with an identical median price of $405,000. And you know what? That's exactly how I feel about last month. That's overall how I'm seeing this market at the moment. We're very much starting to come into, let's say, a settling point due to two factors. First, the frenzy, I feel, is over for now. It's still very competitive out there due to lack of inventory, but whereas back in spring, every home had 10 plus offers and sold for considerably over list price, now I'm seeing two separate worlds start to unfold. Fantastic homes that are priced accurately are still selling with multiple offers in days. Now, overpriced homes that even only a few months ago still would have sold for list price or above are now starting to sit. We're slowly starting to resume normalcy out there. Sellers are starting to realize that value matters. I'm starting to see entire neighborhoods of homes that can't seem to sell. Why? Because the neighborhood had one great home that sold for top dollar. Suddenly, everyone in that neighborhood jumped on that bandwagon, expecting to sell for that same price, even though their homes didn't even compare to that one. Meanwhile, in the grand scheme of things, that entire subdivision is now overpriced because of those 1, 2, or 3 sales. Now that buyers have the luxury of being somewhat more discerning, they're passing on these entire neighborhoods. Like I've said before, when markets are rapidly increasing or decreasing, emotion clouds judgment. Remove the emotional fear of missing out and facing countless rejected offers, and buyers become more sensible. They start comparing more and blindly accepting less. Now, the second factor is simply time of year. Kids are back in school, less people are moving into town, and the holidays are vastly approaching us. So, from a historical perspective, inventory typically starts to drop along with sales. So just because the market is starting to cool off a little bit, this is completely normal activity. Now, before I go, I read this fantastic article this morning that attempted to explain how and why a paradigm shift in society has contributed to increasing home values. In short, they equate the business of owning a home in terms of an actual, let's say, financial tool or business model, if you will. They basically explain how hedge funds can afford to pay multiple times more than actual homeowners like, you and I for that same home. However, they can still make it a viable investment. Meanwhile, if you or I were to purchase and rent it out, we'd be losing too much money to make it a viable venture. I actually found the article fascinating, and there's actually some really brilliant angles to it. I'll post a link in the description below if you feel like some super dense reading, but let me know in the comments. Would you like me to do a brief video explaining why hedge funds and institutional investors were able to blow up home prices? Well, that's it for this month. Thank you all for watching. Please smash the like button and be sure to share this video and subscribe. Have a wonderful September, everyone.